The ranking member will do his, and we'll turn to introductions of our three witnesses, and each of you will have 5 minutes to make your verbal statement, and your complete testimony will be made a part of the record of the proceedings. Good morning, Chuck. How are you, sir? On tax day, Monday, the vast majority of Americans will have paid the taxes they owe. That's because most Americans have taxes taken out of every paycheck automatically and on time. Most Americans understand that paying taxes is not just a legal obligation, it's also a duty to their communities and to their country. But there are super-rich individuals and giant corporations who choose not to pay their fair share of taxes. Instead, they choose to cheat everyone. They hide income in offshore tax havens and construct sham transactions and entities to cheat everyone else. Most Americans don't have offshore bank accounts. The super-rich stash nearly $2 trillion in offshore tax havens. The top 0.01%, representing only about 13,000 households, hold more than a third of that $2 trillion, often through tangled webs of shell companies. The IRS estimates tax cheats cost the U.S. at least $688 billion in 2021 alone. Trump's IRS Commissioner, Charles Rettig, told the Senate Finance Committee that the actual annual tax gap could be $1 trillion. One of our witnesses, Stephen Curtis, estimates that we could raise $600 billion from just a handful of scofflaw corporations for many years' worth of unpaid taxes. We have seen in my lifetime a collapse in the share of United States revenues that corporations contribute, down to 6%, at the same time that corporate profits have soared. A lot of that collapse of the corporate share of America's revenue is through tax tricks like offshoring. In 2010, Congress gave the IRS a new tool to root out offshore evasion by individuals. The Foreign Account Tax Compliance Act, or FATCA, made foreign banks report offshore accounts held by Americans to the IRS. But Republican cuts hamstrung the IRS, and in 2018, the Treasury Inspector General for Tax Administration found that, and I'm quoting here, the IRS had taken virtually no compliance actions to meaningfully enforce FATCA. Most Americans had their incomes reported to the IRS by their employer. The super-rich, with offshore accounts, were on the honor system. Guess how that worked out? For large multinational corporations, compliance can turn on whether the IRS can investigate its way through their armies of lawyers, accountants, and even lobbyists employed to avoid taxes. A huge amount of revenue can be hidden by a big corporation. The IRS has taken one pharma giant to court for $10 billion in unpaid taxes, more than the entire proposed FDA budget for next year. The Senate Finance Committee investigation showed this company reported 60% of its profits offshore, despite making 74% of its sales to U.S. patients. Facebook owes $9 billion for its own offshore tax schemes, according to the IRS, enough to fund President Biden's proposal to expand health coverage for kids. Microsoft, according to the IRS, owes a whopping $29 billion for what one of its executives called a pure tax play, enough lost revenue to fund, for instance, a $10,000 tax credit for American first-time homebuyers. For years, the outgunned IRS, hampered by Republican budget cuts, struggled against billionaires and corporations with virtually unlimited resources at their disposal. In the Facebook case, with time ticking on the statute of limitations, the company sought to run out the clock on the IRS investigation. The IRS had to pause its audit because it didn't have the money to hire an economist. What can we do to stop offshore tax evasion? First, preserve and extend the enforcement funding enacted by the Inflation Reduction Act. We're already seeing the enforcement results. Since last fall, the IRS has recovered nearly $500 million just from millionaires who didn't even bother to file tax returns. Second, the IRS and Treasury should enforce the FATCA law. Mr. Curtis has outlined additional enforcement strategies that deserve serious consideration. Treasury should use its rulemaking authority to close loopholes and improve consistency and fairness. A good start would be reversing the so-called check-the-box regulations for foreign subsidiaries, as Ms. Millen mentions in her testimony. Cracking down on offshore tax cheating would raise billions of dollars a year to invest in our economic future or to reduce the deficit. But it's not just about dollars and cents. It's also about basic fairness. When people who've got the most money cheat on people who've got the least money by avoiding their taxes to get even richer, there's a price. Law-abiding taxpayers have to pick up the slack, public services go underfunded, deficits worsen, and oh, by the way, it's wrong to cheat. And a Congress that takes the side of the cheats demeans itself. Some colleagues think the only way to reduce deficits is to take away government services. Well, that's obviously not true. Some colleagues would rather cut Social Security and Medicare or withhold child tax credits than crack down on big tax cheaters. Well, that would be wrong. If we stop giving big tax cheaters amnesty for their scams, if we clean up our corrupted tax code, and if we make important value-based health care reforms, we can make real progress reducing deficits. I hope that's the path that we choose. And I turn now to our distinguished ranking member, Senator Grassley.
Yes, I appreciate your holding today's hearing on offshore tax evasion and closing the tax gap. I think I have some experience in this area, and I've got some experience on what I think works and what doesn't work, and that's what I'd like to discuss. But talking about the tax gap, I remember what my late friend and former Finance Committee Chairman Orrin Hatch referred to as the tax gap, and this is his quote: "The great white whale of deficit reduction," end of quote. Endlessly pursued, in other words, but forever eluding capture. No aspect of the tax gap has been examined more than that of offshore tax evasion. Between 2001 and 2010, Senator Baucus and I partnered together in an effort to shut down the most egregious offshore tax evasion and avoidance. We enacted various pieces of legislation, held hearings, commissioned studies, and even sent the Government Accountability Office to that famous Ugland house in the Cayman Islands, the notorious registered office home of thousands of offshore business entities. I'm proud of what we were able to accomplish, shutting down egregious tax practices, raised billions of dollars in additional revenue, but not the hundreds of billions some claimed are ripe for the picking. The reality is that there are no poles or pots of gold that can be easily harvested off of the beaches of far-flung tax havens. Even so, we owe it to the honest taxpayer, as a matter of fairness, as the chairman referred to, if for no other reason, everywhere to snuff out tax evasion where we can. Those engaged in tax evasion aren't only shortchanging the federal government, but stealing from the American taxpayers. After all, it's the law-abiding taxpayers who end up footing the bill. That's why I've long championed reasonable policies intended to discourage evasion while providing tools to the IRS to detect tax cheats. But a key word here is reasonable. Whether it's increased financial reporting or stepped up enforcement efforts, Anti-evasion measures must be balanced against taxpayers' rights and the costs such measures imposed on innocent taxpayers. When it comes to catching tax cheats, I've found targeted approaches to being far more preferable to broadly applicable ones that sweep up innocent taxpayers in far greater numbers than tax cheats. One example of an overly broad sweep approach to offshore tax evasion is the Foreign Accounts Tax Compliance Act, or FATCA. Enacted in 2010, FATCA imposed stringent requirements on foreign financial institutions to report to the U.S. Treasury on foreign assets held by their American account holders. In 2010, Democrats sold this law as a solution to wealthy tax cheats hiding assets in offshore bank accounts. Yet, according to a 2022 Treasury Inspector General report, other than assessing $14 million in penalties, the IRS hasn't been able to quantify any revenue raised under the law, and that is despite spending $574 million on implementation and enforcement campaigns. Now, at the same time, FATCA has imposed great costs on the Americans living abroad, according to the 2019 GAO report. Due to the law, many Americans living overseas have seen their bank accounts close or have been unable to open an account. For many foreign financial institutions, the business of Americans living abroad simply isn't worth the additional burdens and cost of complying with the law. Compare this, then, with an approach that I've used, the IRS's whistleblower law I authored in 2006, which has brought in over $6 billion to the Treasury. Under this law, a single whistleblower, now just a single whistleblower, took down an offshore banking scheme that resulted in Swiss banking UBS paying $750 million in fines. In addition, thousands of illicit overseas accounts were closed and offending taxpayers prosecuted. Now, whether it's offshore banking schemes, a tangled web of shell companies, or illicit transactions by shady multinational companies, a single tax blower can bring the whole house of cards crashing down, and at less cost and with fewer burdens for the innocent taxpayer. Finally, we shouldn't discount the value of good tax policy itself in shrinking evasion and avoidance. The Tax Cuts and Jobs Act combined anti-base erosion and profit-shifting measures with a cut in corporate tax rates. Since its enactment, we have seen intellectual property previously held offshore for tax reasons returned to the United States. Moreover, the act of companies moving their headquarters offshore to avoid U.S. tax has ceased. Combating the tax evasion is something we have an obligation to do, but we need to be realistic about what our policies will affect and how much revenue we actually stand to gain. And enacting bad policy and enacting bad policy that increases tax complexity and threatens the international competitiveness of U.S. companies would only make matters worse. Thank you very much.
Thank you very much, Senator Grassley. Let me recognize and thank you for your many years of work in this space, and particularly for mentioning Ugland House, which brings back to me happy memories of my predecessor in this chair, Kent Conrad.
Yes.
Who had a graphic photo that he used regularly of Ugland House.
I saw it thousands of times.
We saw it a lot. It's nice to have that memory of Chairman Conrad revived today.
Yeah.
Our first witness is Ms. Zorka Millen, who is the Policy Director of the Financial Accountability and Corporate Transparency Coalition, the FACT Coalition. Millen previously served as Senior Advisor at financial transparency watchdog Global Witness and also practiced international tax law. Next after her is Stephen Curtis, who is the President of Cross Border Analytics, a consulting firm focused on transfer pricing software and economics. He has 27 years of experience as a corporate practitioner and previously was an economist and partner at PricewaterhouseCoopers and Ernst & Young. Finally, we have Daniel Bunn, the President and CEO of the Tax Foundation, where he has served in various roles since 2018. Previously, he worked for the Joint Economic Committee as part of Senator Lee's Social Capital Project and on the policy staff for Senators Lee and Scott. Ms. Millen, please proceed.
Thank you. Chairman Whitehouse, Ranking Member Grassley, members of the committee, thank you for inviting me today to share my views on how we can tackle offshore tax evasion. I'm here on behalf of the Financial Accountability and Corporate Transparency, or FACT Coalition. We're a broad, nonpartisan alliance of more than 100 civil society, business, and labor organizations. Right now, many Americans are working to meet their tax obligations and file their tax returns before tax day. Most of us want to do the right thing. We are the honest, law-abiding majority. But there's a small, dishonest minority of individuals and businesses who are breaking the law and dodging their taxes, very often by stashing their money abroad. Put simply, offshore tax evasion is a crime. And it's far from a victimless crime because it gives an unfair advantage to tax cheats at the expense of those who play by the rules. When some of us fail to pay what they owe, that takes away money from everyone else. It leads to higher taxes and ballooning budget deficits. And it robs us of the resources needed for shared national priorities like defense, healthcare, education. This is an enormous problem. Trillions of dollars in U.S. individual wealth are stashed overseas, much of it in tax havens, and the main culprits are a relative handful of extremely wealthy Americans. These tax evaders use many tools and tactics, from secret Swiss bank accounts and anonymous shell companies to complex offshore structures. The good news is the U.S. is starting to crack down on these tax dodgers. But to get the job done, it will take resources and determination. I'd like to put forward 4 solutions. First, we need to better enforce our financial transparency laws because offshore tax evasion thrives in secrecy. A breakthrough in our fight against offshore evasion was the passage of the Foreign Account Tax Compliance Act, known as FATCA, which has been in effect since 2015. FATCA requires foreign banks to send to the IRS data on accounts held by U.S. taxpayers and is typically implemented through bilateral agreements with other governments. Research shows that FATCA has helped to reduce deposits by U.S. citizens in tax havens, and that offshore tax evasion has declined by a factor of about 3 over the last decade. But unfortunately, we still see brazen violations. For example, recently a Florida businessman was arrested and indicted for hiding more than $20 million in Credit Suisse and other secret Swiss bank accounts. The Senate Finance Committee has uncovered how Credit Suisse bankers failed to comply with FATCA and with Credit Suisse's plea deal with the Department of Justice. We also need to make sure that the IRS has the resources needed to fully leverage the data disclosed under FATCA in order to collect the taxes that are owed. Beyond our borders, FATCA has had a dramatic global effect, galvanizing more than 100 other countries to join forces to automatically exchange bank account information. But the U.S. is not a part of that global standard, and as a result, risks becoming a tax haven for foreign tax cheats. We should do more so the information flows both ways, not only to help our partner countries, this would also be in our interest. Other countries' willingness to share information with the U.S. depends on our willingness and ability to reciprocate. Second, in addition to FATCA, Congress has created a valuable new transparency tool, the Bipartisan Corporate Transparency Act, which gives the IRS access to a new database identifying the true owners of U.S. legal entities. Ownership transparency is important because shell companies are a significant conduit for tax evasion. For tax, as well as anti-money laundering purposes, the government must continue to vigorously defend the CTA against unfounded legal challenges. Third, we also need to crack down on tax dodging by large multinational corporations through better, tougher enforcement of our current transfer pricing rules. Right now, it's too easy for big corporations to go beyond the law with few repercussions. The IRS needs more resources so it can take on complex transfer pricing schemes by big companies like Microsoft, and Mr. Curtis will discuss that in more detail. But I'd like to point out that transfer pricing also presents huge financial risks for investors. To protect investors from these risks, the Securities and Exchange Commission should mandate more detailed tax reporting by US-listed issuers, requiring basic information for each country of operation, known as public country-by-country reporting. Investor scrutiny would help to deter some of the most aggressive and illegal transfer pricing practices now underway. Fourth, current Treasury rules allow corporations to check a box on a form to effectively make an offshore subsidiary and its otherwise taxable income disappear. This provision, known as check-the-box election, harms our economy and facilitates offshoring of jobs and profits. While technically legal, this tax practice has led to substantial losses to our economy to the tune of more than 1 million American jobs and more than $40 billion per year in lost domestic business earnings, according to a recent Brookings analysis. Treasury should put a stop to these losses and repeal the check-the-box election rule. I want to thank the members and staff of the Senate Budget Committee for holding this important hearing today, and I welcome your questions.
Thank you very much, Ms. Millen. Mr. Curtis, please proceed.
Chairman Whitehouse, Ranking Member Grassley, distinguished members of the committee, thank you for inviting me to share my research on corporate offshore profit shifting and related enforcement issues. I've been performing transfer pricing projects for around 27 years, mostly as an economist and partner in 2 Big Four accounting firms, before starting a consultancy in 2013 to develop forensic models and technology for transfer pricing enforcement. I began publishing these models in academic papers in 2016, and then in 2020 began working with a team of distinguished academics to publish cases of offshore tax evasion by multinationals. As seen here in Figure 1 from my written testimony, this table summarizes 10 of our studies since 2020, including 8 that have been published in tax notes, documenting around $600 billion in revenues that we believe the IRS could potentially recover for violations of a 2009 R&D cost-sharing regulation. We estimate that the amounts owed for similar violations across all U.S. companies employing similar arrangements could reach around $1 trillion or more. Figure 2 shows a chart based on research by Kimberly Clausing, who testified before this committee, showing how U.S. federal and state tax underpayments from offshore profit shifting have grown exponentially in recent decades to around $140 billion per year by 2015. Research in 2023 cited in my written testimony found no material impact on offshore profit shifting after the Tax Cuts and Jobs Act of 2017. Put simply, the IRS is overmatched, understaffed, underfunded, and operating with vast information and resource asymmetries against sophisticated taxpayers with virtually unlimited resources. The IRS audits around 1/3 of the largest 3,800 U.S. companies, and around 50% of these conclude with no change result. And only a fraction of these exams ever involve transfer pricing or the prices assigned to cross-border intercompany transactions by related affiliates of the same multinational company, often manipulated to move taxable U.S. profits out of the U.S. tax net. Here are a few examples of transfer pricing that passed IRS exam. A U.S. company's most profitable subsidiary is a tax haven shell company in Ireland that exists only on paper with no employees. A U.S. internet company serves billions of users from around the world, and its average cost per user is $21, but it records $92 in the U.S. on its U.S. tax returns, but only $12 offshore, which inflates its foreign pre-tax income to twice that of its U.S. pre-tax income. Or a U.S. company that designs, builds, and exports products from the U.S. directly to foreign customers records the majority of these sales and profits in 2 Irish tax haven shell companies for distribution operations that never touch the product. So how does this happen? Well, consider how one company evaded around $100 billion in U.S. taxes despite a decade of continuous IRS exams and a Senate investigation in 2013. Figure 4 from my written testimony shows excerpts from a contract required by the 2009 regulation mentioned earlier in order to be exempt from some of the provisions of that law. Note how the contract contains the words such as functions performed by these Irish affiliates listed in the contract. These words could not be more clear in a document supported by comments made under oath to the Senate PSI committee. However, compare these words with statements shown in Figure 5. These statements were made 3 years later to European regulators, likewise under oath. These comments testify that the purported functions performed by the Irish affiliates in the contract were actually never performed by these affiliates at all, but instead by the U.S. parent company, who booked their expenses against U.S. profits. The income, however, was booked into 2 non-taxable shell company branches of the Irish affiliates listed in the contract. These facts violate a cascade of tax regulations that the IRS currently does not enforce, such as periodic adjustments and effectively connected income, for which we estimate this taxpayer could be on the hook for around $200 billion. In summary, our research over the past decade has found that many corporate tax laws remain unenforced and that offshore profit shifting continues unabated. However, many tax underpayments going back a decade or more remain collectible, some with no statute of limitations. The Inflation Reduction Act funding for the IRS can provide targeted improvements that we believe can recover $1 trillion or more from non-compliant transfer pricing and other forms of corporate tax evasion, while reducing exams of compliant taxpayers and leading to more voluntary compliance so that corporations pay their fair share. I welcome your questions.
Thank you very much. And before I turn to Mr. Bunn, I just want to acknowledge the role of our friend and former colleague, Senator McCain, in the proceedings that you described, Mr. Curtis. We miss him to this day, and I'm glad that you mentioned his work. Mr. Bunn.
Chairman Whitehouse, Ranking Member Grassley, members of the committee, thank you so much for having me here today for this hearing on offshore tax evasion. At the outset, I want to distinguish between evasion, which is illegal, and avoidance, which is the use of different policies that are in the tax code, legal measures to reduce exposure to higher tax burdens. My view on evasion is simple. The Internal Revenue Service should enforce existing tax rules so that evaders are brought to justice and pay the correct amount of tax. On avoidance, we get into a lot of policy questions. There are many things in the tax code, domestic and cross-border, that provide opportunities for individuals or businesses to reduce their legal tax liability. And it is up to policymakers to think through the different trade-offs. Ranking Member Grassley mentioned some of these, on what is the appropriate enforcement mechanisms and the appropriate policies to increase tax compliance. I'll mention the tax gap as well. The chairman mentioned the size of the tax gap, estimated in the $600 billion range for 2021. However, when you look at the gap between revenues and outlays, even 100% compliance does not close the deficit in the years that we've seen, even over the previous decade. So there's a policy question of what the appropriate measures should be to either enforce existing rules or how existing rules could be changed to recognize the trade-offs between policy and enforcement of those policies. The U.S. is an outlier when it comes to offshore income or foreign income. The U.S. has historically used worldwide rules to tax the incomes of individuals and businesses. On the individual side, we are the only country other than Eritrea in East Africa that taxes our citizens on their worldwide income. And that requires us to have different policies to enforce those rules. Now, the whistleblower policies, the FATCA that have been mentioned, those incur different costs for taxpayers to be able to comply with this worldwide tax system for individual income. On the FATCA, what we have seen as it has been rolled out and enforced, we have seen a spike in U.S. citizens who are often living abroad, revoking their U.S. citizenship to avoid the high burden of compliance with the FATCA. So that, to me, suggests there's a problem with the underlying policy of citizenship-based taxation. On the business side, up until 2017, we had a full worldwide tax system for business income where we would pay attention to income earned wherever it was in the world, but there was an option for companies to defer U.S. taxation of their foreign income and not repatriate the profits to avoid paying our 35% corporate tax rate at the time. This created a lot of bad incentives for businesses to create all sorts of creative structures to avoid having to pay that 35% rate on repatriating profits. In 2017, though, policymakers chose to lower the corporate tax rate and enact a number of transition rules and anti-avoidance mechanisms that, in my opinion, have improved the U.S. tax system for corporate income, particularly offshore income. Now, not everything with the Tax Cuts and Jobs Act was perfect, and even some of those anti-avoidance measures are not perfect, but in general, it was a move in the right direction, and we have seen intellectual property profits move back to the United States as a result of the Tax Cuts and Jobs Act and other changes internationally. And that's where I think policymakers should also be thinking, not just with the rear view lens, but also looking forward, paying attention to where policy might change in the coming years. Next year is an opportunity with the expiration of many parts of the Tax Cuts and Jobs Act and changes that are happening around the world for lawmakers to consider what areas of the tax code should be adjusted to improve the incentives for businesses to hire in the U.S., to invest in the U.S., and to see an opportunity for lawmakers to move in that direction rather than just thinking through the number of layers and layers of anti-avoidance policies that have come to be. The corporate alternative minimum tax is one of them, and that is still as yet uncertain for corporate taxpayers because they do not have final guidance even 2 years on from the Inflation Reduction Act. Thank you for having me here for testifying, and I look forward to your questions.
Thank you very much. Mr. Curtis, you discussed the commensurate with income law, which goes back to the Reagan bipartisan 1986 tax reform and its basic non-enforcement. As I understand it, that was intended to prevent companies from mispricing intellectual property allocated to foreign subsidiaries. Is that accurate?
Yes, Senator, it was.
And you have literally decades of experience as a corporate tax practitioner in the major tax and accounting firms of the country, and you've developed forensic economic analyses of offshore structures. How does that work? How does your forensic work lead to the conclusion that these offshore companies are evading taxes?
Sure. So some of the forensic models we've developed are designed to detect violations of transfer pricing principles, so the arm's length principle. So if you see a corporation with high foreign profits, maybe more foreign profits than U.S. profits, you might think that it could be in violation of transfer pricing rules or its transfer pricing is aggressive, but you actually need to look at the functions and risks and assets and how they're distributed and what goes on offshore versus U.S. We have some models that do this using time series analysis of statistical indicators of transfer pricing risk because profit's supposed to follow risk, so how do you define risk, and so all those kinds of things. So once we identify a group of companies that we think have these risks, we then start investigating them sort of forensically. So we start looking for information, especially in offshore filings, like in Ireland. Some of the companies we've researched have filed some things in Ireland that are very difficult for those companies, that if you take a look at those, you can actually see some violations of U.S. tax codes. So we investigate them going down that route. And then for these companies that we've published, they do violate this commensurate with income law. The law regulations were passed to implement that law in 1994 with a periodic adjustment for offshoring of IP, but then in cost-sharing arrangements in 2009, that is the law that the 10 companies that we've written about violate.
Senator Cassidy and I are also working on mispricing as a mechanism for international money laundering. You're talking about it as a means of tax avoidance and tax evasion. Is it also a way in which value can be transferred without proper accounting that allows for money laundering as well? Or is that beyond your?
Yeah, I can only
Expertise.
talk in the corporate context, but in the corporate context, U.S. companies that have people and assets, they also have intellectual property. It's hard to move people and assets, hard assets offshore at non-arm's length pricing, or just to move your people to an offshore tax haven. That's very difficult. So corporations will move more fungible assets. When you're talking about a fungible asset like intellectual property, those assets can be very valuable and difficult to price, and that's where you see a lot of the corporate offshore profit shifting. Now, whether that applies to money laundering, I can't
Yeah,
really
you can
speak
see
to.
how it might work. Ms. Millen, you've suggested that the $688 billion tax gap may actually not fully account for offshore tax evasion. Could you explain that further?
That's right. The IRS is not able to fully take into account offshore tax evasion, so the figure is too low with respect to that. And I think, as you alluded in your opening remarks, former Commissioner Rettig thought so too, and he thought that it could be as high as $1 trillion.
Just to a point in your testimony where you mention that granting access to FATCA data beyond the IRS could help, and I'm quoting you here, law enforcement agencies fighting drug cartels, corruption, sanctions violations, human trafficking, and other major crimes. Is it fair to conclude from that anonymous offshoring in shell corporations has national security and law enforcement issues as well as tax issues associated with it?
Absolutely. I mean, it comes down to the problem of secrecy that enables all of these problems, from offshore tax evasion to all of the issues that you just outlined, and the way to tackle them is through greater transparency.
So not just tax cheats, but terrorists, drug lords, child traffickers, all can benefit from the same secrecy.
That's right.
Thanks very much.
Thank you.
Senator Grassley.
Mr. Bunn, the 2017 tax bill did a carrot and stick approach to the problem of multinationals shifting profits to low tax jurisdictions. Tell us how that tax bill reduced the incentive to engage in profit shifting transactions, and what are some examples?
Thank you for the question. So the Tax Cuts and Jobs Act looked at the difference between the tax burden on foreign income and the tax burden on domestic income, and sought to close that gap. When there's a large gap between a domestic tax rate and a foreign tax rate, there's a large incentive for businesses to shift their profits either artificially or actually offshore activities, physical activities and employment to minimize their exposure to a high tax rate. So the Tax Cuts and Jobs Act, number one, brought the corporate tax rate down, but then had a pairing of anti-avoidance policies, one in the global intangible low tax income, the GILTI, which is a minimum tax rate applied to foreign income, and the foreign derived intangible investment, which is the FDII income, which is the FDII, to balance the difference that companies, when they're thinking about where to put their research and development or put their IP, to allow them to think maybe it makes sense to keep that in the U.S. rather than planning through different offshore structures. At the same time, we saw some changes in other jurisdictions that were helpful for this balance shifting in the U.S., and we've seen a significant amount of IP come from offshore locations back to the U.S. and profits being earned in the U.S. And we can see this in some data that I had in my written testimony showing that royalties earned by U.S. companies on U.S. IP in the U.S. has increased dramatically, especially in bilateral data with Ireland.
President Biden has proposed several changes to the U.S. tax system. So, Mr. Bunn, most notable are reforms to the provision called GILTI. This includes taxing foreign income of multinationals at higher rates than what other countries are expected to adopt as part of Pillar 2 agreement that the Biden administration just negotiated. In addition, President Biden proposed corporate tax increase to 28%. How would these changes affect the competitiveness of U.S. companies? And would these proposals tend to increase or decrease the incentives for multinationals to shift profit offshore?
Thank you for the question. I think they would increase the incentive for planning through various structures and minimizing exposure to U.S. tax. The changes that the president is proposing would increase the gap between domestic and foreign, and do it in a context where a lot of foreign jurisdictions that are adopting the global minimum tax are going to have an effective tax rate of 15%. And if the U.S. has a much higher tax burden through GILTI or the domestic corporate tax rate, then companies are, instead of continuing to bring IP back or keep IP here in the United States, we'll probably see some of those same games to move things offshore or to develop things offshore rather than do them here in the United States.
Also, Mr. Bunn, the administration claims Pillar 2 tax framework will end, and I quote, a global race to the bottom with respect to corporate taxes. However, in reality, Pillar 2 may simply shift the focus from a competition base on low rates and traditional tax incentives towards one based upon providing direct cash subsidies. How do you feel, or how do you expect tax havens to respond to the implementation of Pillar 2?
So we're already seeing some of this response. Some jurisdictions looking at the minimum tax rules, and the minimum tax rules provide for certain things that I think a lot of jurisdictions are looking at with through an attractive lens. The jurisdictions are looking at grants, refundable credits, and different mechanisms that the minimum tax rules treat more favorably than traditional tax credits. I was spending some time earlier this year looking at some of the jurisdictions and how they're planning to implement the rules, but Bermuda is looking at a refundable tax credit. Singapore is looking at a refundable investment tax credit. Switzerland, some cantons in Switzerland are looking at refundable credit programs. And the United Kingdom has had a refundable research and development credit program for a number of years that are treated very differently than our credits. And I think what we are seeing is a shift in this competition from rates to the tax base and using the rules themselves to create advantages for different jurisdictions.
Thank you, Senator Grassley. Senator Johnson.
Thank you, Mr. Chairman. I'm going to try and simplify these issues here because this is incredibly complex what we're talking about. First of all, I think the main root cause here is the distinction between taxing worldwide income and not. I mean, I've known that individuals get taxed on their worldwide income. I was not aware of the fact that only America and Eritrea are the only two countries. Mr. Dunn, the reason we don't tax corporate worldwide income is we would be uncompetitive and we would see inversions of corporations, right? They would just locate offshore. They'd become, again, we don't want to change our citizenship so you can get away with taxing worldwide income in individuals, but corporations, they can be run by U.S. citizens, but domicile someplace else, correct? Is that the basic?
Yes, that's correct.
So if we attempted to tax worldwide income, that'd backfire on us, wouldn't it?
Yes, and it has historically with a lot of the inversions that we saw leading up to the Tax Cuts and Jobs Act.
So the fact that we don't tax worldwide income, that sets up the whole complex issue of transfer payments. And just, paper entries, a legal document that says this IP is owned in that country that has low tax rates, or, all these costs are incurring here. And I mean, that's playing whack-a-mole, isn't it, Mr. Curtis? I mean, you can say you can set up all these rules and all these laws, but you're still just playing whack-a-mole.
That is true. The check-the-box rules help with this as well, because under check-the-box, if you have a shell company offshore and you put the IP in there, offshore, you can split the IP returns into a tax haven, and then you have functional entities that are doing some things. But under check-the-box, your entities underneath get checked into this shell company, or the shell company gets checked into another company. It disappears for U.S.
You're just describing the complexity that we have.
Exactly.
My whole point, any of the three witnesses think that the U.S. tax system is simple and rational? So the thrust of this questioning, I only got 5 minutes, and it's not nearly enough to really explore this, is what could we accomplish by simplifying our tax code, by making it more rational? I mean, to me, income ought to be income. The fact that we have different tax rates for corporate income versus capital gains, I think index out the capital gain and, have a unified tax rate scheme. Things like cash income. We have all these loopholes, they call them. It's just about amortizing, it's depreciating over different years. They're all arbitrary. What would we potentially accomplish, for example, just moving to cash-based income? Would that have any impact on this at all? I mean, forget the paper entries, the transfer payments, or it's like, no, you got the cash in the U.S., you're going to be paying tax on it. I mean, is there some way or ways that we can simplify our tax code, rationalize it, they'll start addressing this as opposed to continue to play whack-a-mole with just something that's naturally complex? Mr. Dunn.
Thank you for the question. The answer is yes. So Tax Foundation has looked at various forms of corporate income taxes, including cash flow taxes. And cash flow taxes are relatively rare across the world, but where we see them working well. There is a paper we put out last year looking at essentially a cash flow tax for the U.S., and it can be both supportive of growth and revenue positive. And these are things that I think lawmakers should be thinking about simplicity while also aiming for certain revenue targets.
Let me also point out, if we would transition to cash-based income, it would simply be a timing difference, correct? I don't know how long a time period it would all work its way out, but yeah, I mean, if you're investing today in some kind of R&D or some kind of capital equipment, you're going to have a lower tax rate because you have less cash on hand. But 5 years, the next 4 years where you're not making that investment, your cash income is going to increase, correct?
Exactly.
Did you have any feel for how many years that would take to play out in terms of that timing difference?
So in the long run, it all works out.
Right.
The challenge is that depending on what you're investing in, whether it's a building or a tractor, the return on investment timeline differs across the economy. In the aggregate, we could see things turn around within the budget window, but more often than not, you're looking outside the 10-year budget window to really see things turn around.
So most appreciation on equipment would be pretty short, right? 5 years, 7 years?
Correct.
Buildings are?
39.
Buildings are what?
39.
Yeah, so I mean, it's going to take a while for that to work. What about R&D?
Well, we're currently amortizing R&D based on I think it's 3 to 5 years, somewhere in there, yes.
Okay.
But that's a change.
Again, what I'd love to have, I'd love to hold a hearing on how do we simplify and rationalize our tax code. Because, again, nobody wants to see tax evasion. I don't know what percent of the tax gap is evasion versus avoidance, as you were pointing out, Mr. Dunn, but avoidance is all about a complex tax system. So anything we can do to rationalize and simplify it, that's the drum I've been beating, and I'd like this committee to take the time to really analyze that. Thank you, Mr. Chairman.
Thank you, Senator Johnson. Senator Van Hollen.
Thank you, Mr. Chairman. Thank all of you for your testimony here today. Mr. Curtis, I'd like to start with you. From your experience, roughly how many tax experts, accountants, lawyers does the average large multinational have at their disposal to try to minimize their U.S. tax obligation? I know there's not a one-size-fits-all, but if you could just give a rough approximation.
Well, if you include people working within the corporations and then their advisors, because most of the large corporations, Fortune 500 and higher, They don't do all of their transfer pricing documentation in-house. They use advisors. And I'll pull a source. So there's a study that was done in 2018 that predicted that there's 250,000 professionals, I believe this worldwide, that do transfer pricing, that are in the industry of transfer pricing. Compared to the IRS, we think has between 100 and 200 people that do transfer pricing inside the IRS. So it's a big number. If even a third of that was in the U.S., it would be 60,000 or something like that. So the IRS is overmatched, maybe 100 to 1, or even more than that.
Well, you totally anticipated my next question, which was what does the IRS have? And you just explained they're totally outgunned when it comes to doing this kind of work. How about on the expertise side, right? Because it's both the number of people that are engaged in this, but also the level of expertise. What kind of expertise and resources are needed for the IRS to be able to compete in that area?
So in the IRS, what you have in the IRS is you have so few resources that people who do, like international examiners and transfer pricing economists, they're tend to be generalists, if you will. They'll come in to, if it's a continuous audit or a random audit, they'll come in and they'll do basically a fishing expedition to try to find what's going on. What sort of I felt, having worked inside the Big Four and how the Big Four operates, is you have experts that are an inch wide and a mile deep in every code section. They know every loophole, every typo. They know how different codes operate to create a loophole. There's also technology. So I took those things and said, well, if you were the IRS, what would you want to do? Well, the first thing you'd want to do is you'd want to take your workforce, and instead of auditing companies where 50% of your audits are no change and doing fishing expeditions and using generalists who don't have a grasp necessarily what might be going on inside the company, or an expert in any number of discrete transfer pricing issues, you would want some technology that would identify the key risks and then put your workforce there. And then take that workforce, build it, add to it, but what you're adding to it is you're adding more specialists in different areas that you can have multifunctional teams really operate more like the industry. Now you can go toe-to-toe with what's going on in the industry. That's what I would say.
No, I appreciate that. And you mentioned technology. You know, the IRS is still operating in some cases on 25-year-old technology. Do you expect that a lot of the Fortune 500 companies are using technology that's older than their employees?
No, absolutely not.
So this is one of the reasons, as part of the Inflation Reduction Act, we provided the IRS with additional resources to help on customer service, yes, but also to allow upgrades in technology, as well as to allow them to hire more people to go after very, very wealthy tax cheats, including corporate tax cheats. And we are witnessing a battle here where some people want to take away those resources and not allow the IRS to at least try to compete with the resources of big corporations. Ms. Millen, I appreciate in your testimony mentioning a bill I've introduced, the Disclosure of Tax Havens and Offshoring Act, and the work that the FACT Coalition is done on the issue of country-by-country reporting. As you mentioned, companies file country-by-country reports with the IRS, but are not required to disclose that information to investors. Could you just expand briefly on how country-by-country reporting can be meaningful for their investors?
Thank you, Senator, for that question, and thank you for your leadership on corporate tax transparency. The information is already available and filed with the IRS. So this is not imposing any additional costs on companies, but it would help investors better assess the very material risks of the sort that Mr. Curtis has described and that his research has documented. And those risks in some cases, they run into the tens of billions of dollars. So it clearly impacts the bottom line for many of these large companies, and yet the investors remain in the dark. So the bill that you've introduced would change that and make this information available to investors so that they can scrutinize the risks that the companies are taking. And in doing so, the hope is that it will also deter some of these most aggressive practices.
Thank you. It's right, an investor right to know to help protect others in the economy as well. Thank you, Mr. Chairman.
Thank you, Senator. We have Senator Kennedy, then Chairman Wyden, and then Senator Braun.
Thank you, Mr. Chairman. Ms. Millen, is your expertise in the area, Mr. Bunn made this distinction, is your expertise in the area of tax avoidance or tax evasion or both?
I would say both. I think the lines, there are situations where the lines might get blurry, especially on the corporate side. But in my...
it's both?
It's both. In short, it's both.
Do you believe that there are major American corporations that are cheating on their taxes?
I think yes, there are cases where the transfer pricing regulations are not being followed, and Mr. Curtis's testimony speaks to that.
Who are they? Who are the five? Name the five American corporations that are the biggest tax cheats.
Well, this is a question for the IRS. It's their job to enforce the laws. So I wouldn't.
But that's a pretty serious allegation you made there, and I'm just asking you who they are.
There are cases pending against a number of companies until those cases conclude. It's not.
Who do you think they are? You're an expert in this area. I'm just asking you. You talked a lot, and I've read some of your writings about American corporations cheating on their taxes. I'm just asking you who they are.
I wouldn't use the word cheating. I think that they are taking advantage of the gray zone.
You used it in your testimony.
I'm sorry?
You used it in your testimony. I'm not trying to trick you. I just want to know you have been very vociferous in saying that American companies are cheating. Okay, that's America. You're entitled to your opinion, but you're an expert, and just tell me who they are.
I stand by that. I think that there is evidence to suggest that some of these companies and the IRS has pursued cases against a number of the companies that Mr. Curtis has analyzed, including Apple and Microsoft and Facebook and
Is
Coca-Cola.
Apple a tax cheat?
I wouldn't say tax cheat. I think that's putting it too strongly, and I didn't use that word.
Then who are they?
I wouldn't say tax cheats, but I think they are crossing the legal lines that have been set by Congress and by the IRS in the relevant regulations. And because the IRS is outgunned, they're not able to enforce the law against them.
Let me start over. Do you believe that there are major American corporations cheating on their taxes?
I believe they are coming very close to crossing the line, and it's difficult for IRS that is outgunned to enforce the line.
Are they crossing the line or not?
Well, it's up to the IRS to enforce the line if they don't have the resources.
I'm asking you your opinion. You're an expert.
I think there's a good case to be made that, yes, they are crossing the line.
Yes. Okay.
Yes.
All right. Who are they?
That's up to the courts and the IRS to determine.
You made this allegation, but you don't want to say who they are? If you know who they are, you just don't want to tell us?
I think that's been explained by Mr. Curtis in his analysis.
I'm asking you to explain. You talk about tax cheats. I'm just asking you who they are, and you don't want to tell us?
It's again, I think it's for the IRS to enforce the line, and we need to make sure that the IRS is properly...
Well, do you have a list of these tax sheets?
No.
Okay. Have you been to the IRS and said, here are these companies and they're cheating on their taxes and I can show you how they're doing it?
No, I'm not. That's not I've never practiced in that area of law. I'm not a tax whistleblower lawyer.
All you've done is run around saying American companies are cheating on their taxes. I can't tell you who they are, and I haven't been to the IRS to show my data to the IRS. but I want you to believe me that they're cheating on their taxes. Is that your testimony today?
No, Senator, no.
Sure sounds like it.
I think that the case against some of these companies has been well
Which
documented
companies?
in the
Which companies? Let me ask you one,
public.
because I'm going to run out of time. Tell me, in the last 23 seconds, here's your chance. You believe they're major American corporations cheating on their taxes. You just testified to that. I believe you told me yes. Tell me who they are.
I think there are the companies that Mr. Curtis
Tell me who
discussed
they
in
are,
his
your
in his
opinion.
testimony.
Tell me who they
It
are.
includes some of the big tech companies.
Who are
It
the
includes
five
some of the
worst?
pharma companies that are.
Who are the 5 worst?
I don't have a ranking. I have
You're
not
not going to
compiled.
tell. You don't want to say.
I haven't looked into that.
You understand it makes it hard to believe your allegations if you won't tell us who they are. Talk's cheap. You ever heard that expression? Thank you, Mr. Chairman.
Senator Wyden,
Thank you very much.
actually done some investigation in this space.
With your cooperation, I very much appreciate it and glad that you're digging into these issues. Ms. Millen, for you, the Finance Committee has conducted a number of investigations into the role of Swiss banks who've been implicated in major offshore tax evasion schemes, including Credit Suisse. One of these investigations looked into the Swiss bank Mirbeau, where Robert Brockman hid more than $1 billion from the IRS for over a decade. And as Chairman Whitehouse knows, we've long been concerned by the general lack of criminal prosecution of bankers and other enablers complicit in major tax evasion schemes. And I know my colleagues are talking about naming people and all the rest. I just named people. We named them. And we said specifically, we're talking about somebody who hid more than $1 billion from the IRS for over a decade. And I'd be curious in your thoughts, how is it credible for foreign banks to claim that they did not know who has an account like this? I mean, I heard my colleague from Louisiana said name some names and all the rest, so we're talking about naming a name. Somebody who had $1 billion hiding in a Swiss bank, and I'm just curious how you can claim that you didn't know it if you're a banker.
Thank you, Senator, for everything that you and your Senate Finance staff have been doing to expose these issues and the ways in which we still see too many violations of the Foreign Account Tax Compliance Act. It's absolutely what you described with the Mirbeau Bank is a very obvious breach of the law. And when such cases are uncovered, it's important that the DOJ and IRS are very tough on not just the banks and the bankers, but also to make sure that they turn over the names of individual account holders. Unfortunately, that hasn't always happened in the past with respect to some of these DPAs and MPAs that DOJ has signed in this area. So that's, hopefully a lesson learned.
Aren't the bankers required to know who their customers are?
Absolutely, and they're required not only under FATCA, but also under rules, anti-money laundering laws.
That
so
leaves us
absolutely,
with
yes.
kind of a choice. Either they ignore the law or they're not capable of looking at their customer. I mean, it just kind of defies credulity here to believe that they don't know about somebody sitting on $1 billion. So what is it? They don't follow the law? They don't care about the law being on the books and think they're going to get away with it? I mean, how does this
I agree with you. I think that they should know. It's willful blindness if they claim that they don't know. Perhaps if there was more resources put into enforcing FATCA, then we would see more of a deterrent effect.
I know of your work. I will tell you, I don't think this is a resource issue primarily. This is a question about whether you consider it important. If you consider it important, you go out and do it. And if you bump up against a situation where you don't have the resources, you come to the Congress. And let me ask you about one last example in the remainder of my time. The Finance Committee exposed how Credit Suisse bankers helped a family with dual passports living in Miami hide over $90 million from the IRS and DOJ. We are unaware of any charges being filed. What kind of a message is DOJ sending when they don't bring cases against bankers who willingly help American clients hide money offshore? And pretend you're talking to the people at the Department of Justice, because I have. I've talked to them repeatedly. And I have been pretty spirited in my comments about how it is when our terrific investigators who are sitting behind me bring this stuff to them, and we work with Chairman Whitehouse on it, and nothing happens. What kind of a message does it send for DOJ to basically sit back and kind of do nothing?
That's unfortunate and disappointing to hear. And, I share the concern, and I would hope that the DOJ would step up their enforcement efforts to make sure that there's a really strong deterrent effect that is as intended by FATCA.
For you and other people who are thoughtful and well-respected on these issues, I hope you communicate that to the people at the Department of Justice as well, because I've done it on a number of occasions, and we are still waiting, and we're going to keep pushing. Thank you, Mr. Chairman.
Let me interject for 1 second before I turn to Senator Braun, because this is an area where I've spent some time, and I really appreciate Chairman Wyden's work here. And part of the problem is that the Department of Justice, before it brings a tax enforcement prosecution, insists on there being a referral from the IRS to the DOJ, even where the challenged conduct is as simple as filing a false statement under 18 U.S.C. 1001, which is bread and butter prosecution for DOJ. So you can get very quickly into a situation in which the IRS won't make the referral, so the DOJ won't prosecute, and the whole thing just flops, and the ball falls between the second baseman and the shortstop over and over and over again, because the protocol for these IRS referrals is a disaster from a point of view of enforcement. Sorry to seize that editorial moment, but
well said.
Appreciate it. Senator Braun, my apologies for taking some of the time ahead of you.
Thank you, Mr. Chairman. I'm sure you'll give me a little latitude to go over my standard 5 minutes since I'm the last one here, too. Maybe.
To a reasonable point, yes, sir.
Very good. Ms. Millen, I'm not going to ask you to identify who the companies are, but I'm going to see if you've got a good grasp of kind of the macroeconomics of what we're dealing with. Let's take the year that just was concluded. By the way, we never did a budget within fiscal 23. We're in some type of movement. I guess we just got that done without a budget with the two big spending bills. We need to get more process into all that, and I think we'd end up with better results. But in 23, what were federal revenues, since you're talking about a gap there that we need to kind of shrink due to better tax compliance and everything that you can do? Do you know what our federal revenues were that we ended up with in fiscal 23? And if you don't,
I don't know
you
that off the
probably
top of my
know
head.
the deficit amount roughly, correct?
There is a substantial deficit, yes. And
Want to take a stab at what that is or what it was for the last fiscal year?
I'm not sure.
It was 1.9 trillion. Do you want to know, can you tell me what the Biden administration has forecast over the next 10 years in terms of what kind of deficit structurally we'll be running?
I haven't looked at those numbers.
Well,
My
that's pretty
specialty is
simple.
international
That's pretty
tax law
simple,
policy. I
too.
haven't looked at those numbers.
I think it's important because it's $2 trillion a year. And we're now currently $34 trillion in debt. We were only 18 trillion in debt when I got here a little over 5 years ago. And as far out as you can see, we are borrowing and spending. And this is something I hope you know. What has been the average that we've generated as a percentage of GDP from revenue raised over the last 50 years as a percentage of our GDP?
I'm not sure. I couldn't say.
Well, I would hope that being an expert in the field of trying to shrink that gap, you'd learn more of that. It's been 17.5% of our GDP. So if you look at what we did in 23 with revenue, which would have been record levels compared to what it would have been not too long ago, it was 4.4 trillion. That was 16.5% of our GDP. We spent 23.7%, 6.3 trillion. That is in the books. It just occurred. We are headed towards that again in 24 and for the next 10 years out. In the last 50 years, we've never brought in more than 17.5% of our GDP. With high rates, when you flush a little more into the Treasury, you start to dampen economic growth. When you cut taxes, you take a little bit away from the Treasury, you bring more in due to economic growth. Is there any possible way where you can be credible that we got a tax compliance issue as opposed to a spending issue when you look at those statistics? Remember, we're currently spending nearly 24% of our GDP. We've never historically raised more than 20%, 2 years during the Clinton years out of the last 50. So do you think we have a tax compliance issue or a spending problem? That's a fairly easy question.
I don't study spending issues, but I can assure you there is a tax compliance problem. And so even if it wouldn't go all the way towards closing the deficit, it is still something that we should address as a matter of fairness and rule of law. Whatever the GDP share is, you said 17.5%.
5% historically over 50 years.
It is important that everybody is contributing their fair share
what do
according
you
to the
think
law.
if you threw everything in the kitchen sink at it, what would you do? Hopefully you've got that figure in terms of generating additional revenues. And at what cost would it come? How much would it cost to do it? Do you have that there?
I'm sorry, I'm not following what the cost
In
would
other
be.
words, what is the most you think we could generate in extra revenue if you threw everything in the kitchen sink at it? And what would the cost of doing it be? So you can net out what that difference would be towards a $2 trillion deficit.
Well, I think there are experts who have looked at the return on investment in terms of greater investment in IRS resources. And it's something like,
well, again, experts probably looked at it. I think you're one of them. I can tell you that the Trump tax cuts were almost paying for themselves. And that was $150 billion annually over 10 years, 1.5 trillion. That is just a small amount of a $2 trillion chronic deficit. Before I do run out of time and push the latitude of having a little extra conversation here, I want to turn to Mr. Bunn. Would you want to weigh in on that in terms of, since I didn't get an answer there, what you could possibly garner after the cost of doing it in terms of extra revenue, and how does that compare relative to spending that has never, ever been close to 23 or 24% of our GDP in history other than in wartime?
Thank you, Senator. If you were to fully close the estimated or projected tax gap, you'd maybe get, a 0.5 percentage point on GDP, but the 100% compliance, I think, is relatively unrealistic. But you can think through
And would you
policies.
put that into, since we've been talking about dollars, roughly what that would be? How many billions a year?
So their estimated tax gap is about 600 billion a year. So that would require full 100% compliance. And then, as has been discussed, there's some questions about whether that covers the full tax gap.
Is that net of the costs of trying to get it?
No. So you would still need additional IRS
Okay, so
enforcement
let's
and
just
things of
stop
that
there.
nature.
So that would be 1/3 of the gap. The other 2/3, clearly, we're spending too much. We're borrowing it from our kids and grandkids. Jamie Dimon, who would be respected in the private sector, just said it's the biggest issue economically going forward. Jerome Powell finally got rid of the modern monetary theory that it doesn't make any difference how much your deficits and your cumulative debt would be. You've got two renowned experts that have said
Braun.
this place is going to swamp the system under our current policies.
I have to get to judiciary, and it's starting to wrap up, so.
I
if
think
you could
I've made
wrap
my
up, I'd
case.
appreciate it.
Thank
You
you.
do very eloquently, sir.
Thank you.
Thank you to all of the witnesses. I think I'd like to ask each of you a question for the record that you can get back to me with. I showed this graph that shows the decline in the share of corporate tax revenue as a portion of United States tax revenue. It's run in recent decades from a high over 30% down to current levels of about 5 or 6%. I'd be interested in your thoughts on where you think the sweet spot is. What is the right number or range of corporate tax revenue as a percentage or portion of overall U.S. tax revenue, if you have thoughts on that? With that, thank you very much. And committee members' questions for the record will be due by noon tomorrow. We ask witnesses, if you receive further questions for the record, to get back to us within 7 days. And this hearing is adjourned. Thank you again.